Good morning, everyone. Thank you for joining us today. My name is Prachi Sharma, currently serving as a Business Development Associate at MBG Corporate Services. I'm delighted to be your host today for today's webinar on topic Understanding Safe Harbour Regime in India. In today's session, we will be covering the fundamentals of Safe Harbour, the monumental shifts happening between the Income Tax Act 1961 and Income Tax Act 2025, about Form 49 and actionable strategies for your businesses. Before we begin, let me give you a brief introduction of our company, MBG Corporate Services. MBG Corporate Services is a leading business advisory firm that helps organizations to grow and succeed in a constantly changing business environment. We were established in 2002 and headquartered in Singapore. Today, we have a team of over 600 professionals and operate across Europe, the Middle East, and Asia with 16 offices and in 8 countries. Over the last 20 plus years, we have served more than 5,000 clients globally, including many Fortune 500 companies. Our focus has always been on delivering quality, consistency, and practical solutions that help businesses transform and grow. Moving on to our global presence, at MBG, we have dedicated teams for different regions such as India, Japan, the Middle East, China, and Europe. This allows us to understand local regulations, market conditions, and business needs more effectively. As a result, we are able to provide more customized and efficient solutions to our clients across the globe. So now the question arises, what makes MBG Corporate Services different? At MBG Corporate Services, we follow a 360-degree approach, which means we look at every aspect of a business before giving solutions. Coming to first one, which is industry point of view. Our team has experience across different sectors. This helps us to understand the specific needs of each business and give practical solutions. Second, on the regulatory risk, we have strong knowledge of laws and compliance requirements across different regions. This helps our clients stay compliant and avoid risk. And lastly, in consulting, we bring together different ideas and experience to solve business challenges in a simple and effective way. So overall, it's a mix of industry experience, regulatory knowledge, and practical approach that makes us stand out. Now, giving an overview how MBG supports businesses at every stage of their journey. From the pre-launch stage, where we help with research and feasibility, to the launch stage where we support in setting up the business. As company grows, we assist in improving performance, managing risk, and strengthening processes. In the later stages, we focus on expansion, compliance, and helping businesses enter new markets. So, overall, MBG works as a long term partner supporting growth at every step. Now, let me walk you through the range of services we offer. We provide end to end business solutions supporting companies at every stage, from setting up to expansion and growth. Our services include first, market research. In market research, we study customer behavior, preferences, and segments to give clear insights. We also help in building and improving brand positioning. Our work includes customer satisfaction studies, focus group discussions, and user experience research to understand what customers really think. We also map the customer journey to identify areas of improvement. Coming to the second one, market entry services. We assist companies looking to expand into new markets by conducting in depth market research, feasibility studies, and competitor analysis. We also help with regulatory requirements, entity setup, and strategic planning to ensure a smooth and successful entry. Third, transaction advisory services. We support businesses through transaction life cycle, including merger, acquisitions, investment, and restructuring. Our service include detailed due diligence covering financial, legal, and operational aspects to help clients make informed decisions and mitigate risk. Fourth, risk advisory. We help organizations to identify potential risks across their operations, whether financial, operational, or regulatory. Our team works closely with clients to design and implement risk management frameworks and strategies that help to minimize exposure and ensure business continuity. Coming to the fifth one, that is taxation advisory and compliance services. We design tax-efficient strategies tailored to their client's business model and operations. Our focus is on optimizing tax positions while ensuring full compliance with applicable tax laws and regulations. We assist clients with timely and accurate filing of tax returns, maintaining compliance and statutory requirements, and representing them before tax authorities wherever required. Sixth, financial reporting and assurance services. Our team conducts audit and provides assurance services to ensure that financial statements are accurate, compliant, and transparent. This helps us to build trust among stakeholders and ensures adherence to applicable accounting standards and regulations. Seventh, corporate and other regulatory advisory. In this segment, we help businesses to manage their legal and regulatory requirements. This includes company law matters, fraud recovery reports, the legal assistance such as disputes and arbitration. We also guide clients on employment laws, capital market regulations, real estate matters, and necessary approvals. In addition, we also support with competition laws, international trade regulations, and contract management. Last but not the least, human capital consultancy. Our HR advisory services include payroll management, compensation benchmarking, organizational structuring, and employee development. We help business to build strong and efficient human and capital framework aligned with their growth objectives. Our approach is always tailored to meet the specific needs of each client. MBG Corporate Services works across multiple industries. Being an industry agnostic firm, it allows us to adapt to different business needs and provide customized solutions for each sector. This flexibility helps us to deliver and value to a wide range of clients. Now, I would like to introduce our speaker for today, Mr. Abhinandan Agrawal, Deputy Manager at MBG Corporate Services. He brings over 6 years of professional experience in transfer pricing and advisory. Having worked with leading consultancy firms, his core expertise lies in pre-transaction advisory, development of group transfer pricing policies, drafting intercompany agreements, and conducting benchmarking studies. He has extensive experience in preparing master files and local files across multiple jurisdictions and has handled transfer pricing assignments for a wide range of industries and transaction models. In addition to transfer pricing, he also has the prior experience in auditing, direct and indirect taxation, and regulatory compliances. With that, I would like to invite Mr. Abhinandan to take the session forward.
Hello everyone and very warm welcome in today's session. I'm going to deep dive into a topic that is critical for the multinational enterprise operating in India, the transfer pricing safe harbor rule. If your company engages in the international transaction with its associate enterprises, the strategy we discuss today will help you secure tax certainty and significantly reduce your compliance burden. In simple terms, safe harbor rules are the presumptive taxation framework. When you adopt minimum prescribed profit margins set up by the government, the tax authority will accept your declared tax transfer price as is. It effectively creates a safe zone, meaning the tax department will not subject those specific transactions to a transfer pricing audit. Moving to our next critical slide, we have visual metrics that map out a specific category of eligible transactions and the absolute preconditioning attached to them. Opting safe harbor isn't just about applying the prescribed margin. It's about proving your transaction fits perfectly into these specific buckets. Let's walk through key categories. Starting on the left, we see two major service category. IT services, which historically includes standard ITES, KPO, and contract R&D. And the second, contract R&D services, specifically for the generic pharmaceutical drugs. If you look into the corresponding circles below them, both the extracts, same strict preconditioning, they must be executed with insignificant risks to the foreign principal. This is a massive audit trigger. If your function analysis shows that your Indian entity is assuming significant entrepreneurial, market, and R&D failure risk, the tax authority will reject your safe harbor application. You must operate as a routine, low-risk, or captive service provider. Next, we have the core financial transaction, corporate guarantee, and intragroup loan. The corresponding condition for both is that they must be provided to foreign principal. This means a safe harbor rate applies significantly to outbound transaction where the Indian enterprises is extending financial support or credit risk to its foreign associate enterprises. For those in the manufacturing space, we have the manufacture and export of core and non-core auto components. The qualifying condition here is highly specific in the numerics. 90% or more of the total turnover during the previous year must be in the nature of OEM sales. Finally, we have the low value added intergroup services. The preconditioning here is these services are received from one or more group entities. This cover the inbound routine services such as global HR, IT help desk, administrative services, and the Indian subsidiary received and pays for its global headquarter or sister companies. Moving to the next. Currently, we are experiencing a massive shift in Indian taxation. The transition from Income Tax Act of 1961 to the Income Tax Act of 2025 completely remapped the safe harbor landscape. Previously, under Section 92 CB, the IT sector was fragmented. IT, ITES, KPO, and contract R&D, and all different margins ranging from 17% to 24%. Under the new Section 167, this is consolidated into a single head, Information Technology Services category, with a flat margin rate of 15.5%. Even more significantly, the eligibility threshold of IT services has jumped from 300 crores to 2000 crores. The approval process is also shifted from manual examination by assessing officer to an automated rule-driven process, and the old form 3CFA are being replaced entirely by a simplified form 49. The government has laid down clear rates of various eligible transactions. For example, data center services, a new category included in the Safe Harbour rule, requiring a 15% margin with no revenue cap. Second, contract R&D related to generic pharmaceutical drugs, set of 24% margin for the transaction threshold of 300 crores or ever. For the corporate guarantee, flat rate of minimum 1% of commission of the guarantee amount. For the manufacturing and export of auto components, the core components require 12% of margins, while non-core components require 8.5%. Low value added services, 5% of the receipt of intergroup services transaction up to 10 crores. I want to pause here and specifically detail the transaction listed in our schedule regarding intragroup loan. Financing between associate enterprises is one of the most highly scrutinized area in the transfer pricing. The Safe Harbor rule driven these into three distinct transaction types based on the currency and the quantum of the loan. Starting with the first, advancing to the intragroup loan in Indian currency. This cover where the Indian parent or subsidiary advance a loan to its foreign associate enterprises in Indian rupees. The acceptable interest rate is determined by taking the State Bank of India 1-year marginal cost of fund lending rate as on 1st April and adding specific spreads. These spreads ranging from 175 basis points for the highly rated entities to 625 basis points for low rated entities with a credit rating of C2D. If borrower is unrated or the loan is under 100 crores, the flat 425 basis points spread applies. Second category is advancing of intragroup loan up to 250 crores in foreign currency. This applies when Indian entity provides a loan to its associate enterprises in foreign currency. For example, US dollar, euro, or pound, and the total amount is equivalent to rupees 250 crores or less as on 31st March. The benchmark here is reference rate of that specific foreign currency as of 30th September, and the required spread added to the base rate from 150 basis point for the top rated entities to 400 basis points for the lower rated entities. And lastly, advancing of intra-group loan in foreign currency loan amounting exceeding 250 crores. The base reference rate remain the same, but the higher financial exposure, the tax authority deemed a higher return, while highly rated entities still require 150 basis points, and the spread for the lower or unrated entities increase up to 600 basis points. Now, if you decided that these prices make sense for your business, the compliance mechanism is straightforward. You must file Form 49 simultaneously before the due dates of filing your tax return. The form is split into two sections, Part A and Part B. Part A covers the basic particulars, while Part B covers where you officially declared your option for safe harbor, specific tax years, your eligible international transaction, and your eligible business. To conclude why your board consider opting into these regimes, it boils down to absolute financial certainty and the prevention of litigations. It saves you from maintaining massive TP documentation files and frees your management to focus on the business expansion rather than responding to the tax authorities. Your immediate action item walking away from webinars should be impact assessment, GCC scaling, lock-in period. Impact assessment means you have to determine your defending software margin of 17 to 18% equivalent to your equivalent if you can strategically optimize down to new 15.5% unified rate. GCC scaling assess if your global capability center can now be brought under safe harbor given the newly expanded 2000 crore threshold. Lock-in period talks about 5-year lock-in to ensure complete tax stability during your company's major growth phase. With this, I would like to thank you all for your time and attending this session today. I'm handing over it to Prachi for the closer. Thank you.
Thank you, Ms. for sharing your valuable insights on the Safe Harbour regime in India. One of the key takeaways from today's session is how the Safe Harbour brings certainty by using prescribing margins and reduce transfer pricing audit risk. I hope everyone found today's session informative and useful for their business. Thank you once again for joining us today. We look forward to stay connected and supporting you in the future with MBG.